from New York City for our viewers worldwide. I'm Sonali, Basak, and Bloomberg Real Yield starts right now. And coming up, geopolitical risk increases as Israel attacks Iran. And even with the conflict, U.S. Treasury yields are hitting session highs, cutting into this week's gains. This all comes as financial heavyweights Jeff Gundlach and Paul Tudor Jones both send warnings about the U.S. fiscal situation. But we begin with the big issue, geopolitical risk thrust into markets.
Markets might have sniffed some of this out.
It's a pretty rational reaction to see treasuries roughly trade flat.
I don't expect the rally that we're seeing in the 10-year today to persist.
Ultimately, we need to follow the data.
There is indeed going to be some upside pressure on inflation.
You have concerns about growth, you have geopolitical concerns, and the latter pushing some safe haven demands.
People do not view the U.S. assets or U.S. policy or U.S. fiscal policy as safe as it once was.
The problem's gotten larger and larger and larger, and I think we're getting pretty close to a breaking point.
The Fed sort of stuck between a rock and a hard place.
If you have higher inflation, the Fed should be hiking. If you have lower growth, the Fed should be cutting. So which one is it?
The Fed is going to wait longer than they usually would before they cut.
The Fed wants to be, quote, late to the game.
Well, I expect them to not do anything.
The Fed's right to sit tight.
They want to keep inflation expectations anchored.
The Fed is going to wait and wait and wait until they know what the tariff story is and what the tax story is. And at that point, they can assess the economy. But until that point, they've really got no reason to ease.
In a conversation earlier with Rebecca Patterson at the Council of Foreign Relations, she said the bond market rally wouldn't last, and she's been right. I've been watching throughout the course of the day that 10-year yield inch higher. This is a two-day move over the last 48 hours. Tied to headline risk, tied to Israel and Iran. I will say that over the course of a 5-day period, you've seen the 10-year yield hover between 4.3% and 4.5%. But this move higher in yields really shows you that the 10-year, at least, is not the safe haven asset, at least for now, that you have typically seen in times of stress. Let's flip up the board here and see what's happening even on a longer horizon. We were on the pace for the best week since April on the heels of cooler inflation, a strong auction that a lot of people were very concerned about this week. Yields are moving higher today, as we have been talking about. It has cut into those gains. We were, as I said, looking at the best week since April. We will keep a close eye on those longer term moves. But speaking of the fiscal outlook, because this is what a lot of these longer term bonds are tied to, DoubleLine Group CEO Jeffrey Gundlach had a strong warning about the trajectory of U.S. debt, speaking to Bloomberg earlier this week.
The reckoning is coming is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking.
Joining us now, Anders Persson, CIO for Global Fixed Income at Nuveen, and Jean Tannuzzo, Global Head of Fixed Income at Columbia Threadneedle. How do you both view geopolitical risk in the bond market? Are we pricing in risk appropriately? And is the safe haven really holding up in terms of how investors are seeing the bond market today? Jean, get us started.
Yeah, look, I actually think today's behavior is not particularly surprising. If you look at what's going on geopolitically in the Middle East, most of that risk premium right now is being housed in oil, but we are seeing the dollar strengthen. And it's also true, as you mentioned earlier, that treasuries have done pretty well recently. So I think the market is waiting to see if there's further follow through that's going to affect risk. Unfortunately, geopolitical risk in the Middle East is not a new phenomena. So just to rely on that to push 10-year treasury yields around is probably insufficient at this point in time.
You know, Anders, you think about not only the longer term yields here, you look at the shorter term as well. One worry that exists in the market today is that if you see oil prices remain higher, that it could impact inflation and therefore make the job harder for the Federal Reserve. How do you see that tension playing out?
Yeah, no, I think that's a key point here, and I'll tie that into Jean's point that the move here has been fairly rational in our mind, because there are some of these offsetting factors, right? Some of the flight to safety aspects of this conflict is certainly offset by the oil potentially impacted inflation, and certainly that's going to feed into some of these moving pieces, so to say. So, our comfort level is a lot higher on the front end of the curve. We think it's going to be more tied to Fed moves, and we do expect the Fed to be patient and not do anything next week necessarily, but certainly be cutting later this year. So from that perspective, we're more comfortable being at the front end of the curve, a little bit more cautious on the long end of the curve.
To that end, you are seeing, Gene, the front end of the curve react marginally. You look at WIRP on the Bloomberg terminal, and the market is pricing in just under 2 rate cuts through the end of this year. What is your expectation, and do any of those cuts get put at risk given the geopolitical situation and the risks to oil and supply chains?
I think the risks are actually quite balanced. I think if you look at the Fed's mandate between the labor market and inflation, we would say that inflation is moving into the zone of irrelevance for the Fed right now. Yes, tariffs create uncertainty, but the Fed is likely to look through tariffs as a tax that they can't influence. And other factors related to inflation in the background are actually getting much more favorable. And the overall inflation situation as we sit here today in the rearview mirror is very similar to where it was pre-pandemic. So really that comes down to the labor market that's going to drive their policy response. And if you look back to last year, we went from a Fed that was on hold to a Fed that was cutting in an oversized 50 basis point cut in a very short period of time. It was basically from July to September, from a very short rise in the unemployment rate. I think it's very plausible that we could see such a move again. So I do think there's room to pull cuts forward.
I do want to point out something you were saying a little earlier, Anders, that worry about the longer end of the yield curve. Now, Jeff Gundlach was not alone among billionaires sounding the alarm on U.S. debt this week. Take a listen here to Paul Tudor Jones speaking to Bloomberg Television earlier this week.
If we had to balance a budget, it probably would be the big beastly bill. And at some point down the road, who knows when that's going to be? Maybe it's next year, maybe it's the next administration, maybe it's 10 years down the road. At some point, probably, the bond markets are going to call BS on governments around the world playing chicken with them.
For all the concern about foreign buyers stepping back from the Treasury market, the 30-year went okay. And interestingly enough, I got back from Hong Kong just yesterday. Investors from Germany and from Hong Kong, when I asked them if they were concerned, they say yes. When I asked them if they would still buy into the 30-year, they also still said yes. Anders, where is the concern and when does it start to make a difference?
Yeah, no, I think that's effectively spot on. I think investors, including non-U.S. investors, I just got back from Australia a few days ago, and investors were pretty much saying the same thing. We're very concerned. I would say it's one of the key questions I get asked when I travel globally around what's the fiscal kind of situation going to look like for the U.S. longer term. But at the same time, they come back to the yield environment being quite attractive. So when you're pushing almost 5% on the 30-year, that ultimately is quite attractive for investors more broadly. So I think it's one of those where it continues to be, medium to long-term concern, maybe not as much a short-term concern. I think a lot of investors also trying to figure out what is this White House administration's kind of policy going to look like? Is this going to work out or not? And, keeping that in mind, but not necessarily making a decision on it just yet. So very much front of mind, but not something that's, scaring investors off at this point, including foreign investors.
Gene, would you bite on the long end of the curve, right? The yields are interesting. They have been somewhat range bound, but a lot of concerns about where it goes from here.
In general, yes, we would prefer the 5 to 10 year part of the curve. Any fiscal risk premium is going to build at the long end because there are fewer natural buyers there. But in the scheme of things, the market is likely shifting its focus over the next couple of months away from tariffs and towards fiscal policy and the big, beautiful bill. And I think the focus there is going to be what is the balance of growth that comes from that relative to the supply of treasuries that come from that. And if we look at the growth side, we actually think it's going to be very marginal. Most of what is being focused on is extending existing policy rather than creating new growth stimulus. But on the other side, the supply is still pretty significant, and we're looking at 10-year auctions that are already over 50 billion, which is more than double where they were a few years ago. So that supply is going to continue to be there. We like 5 to 10 year in the U.S., but we diversify that with some other developed markets like Germany and Japan.
I want to point out that also we have President Trump yesterday saying again that he wants the Fed chair, Jay Powell, ahead of the Fed rate decision next week. He wants lower rates. Take a quick listen to what he had to say.
We can't get this guy to do it. And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad, but I'm not going to fire him. I just want him to, we call him too late, right?
Of course, Bloomberg News reporting this week as well that among the contenders for the next Fed chair includes Treasury Secretary Scott Bessent. Now, a lot of questions about whether Bessent, if he were to become Fed chair, would be more dovish than, say, a Kevin Warsh, who has historically been more hawkish. Anders, how do you see this playing out, and what does it mean for current policymaking when you have investors who are looking farther out, making longer-term decisions based on what might happen in 2026 and beyond?
Yeah, I mean, it certainly introduces a level of uncertainty that the market is not going to be super excited about. I think for now, I think the focus is around Powell and the current committee and what they're going to be doing. And expectations, as we just mentioned, is for additional cuts in the markets anyway. So the markets are pricing in 2 cuts later this year. So it's not necessarily the market is kind of way off from what Trump is hoping to see here going forward. And if Bessent or somebody else steps in, we would expect that kind of momentum to continue. We're expecting more cuts next year anyway. So from that perspective, I think it would be quite different if Powell was saying we're looking to hike or we're completely pausing, that kind of type theme. But since we're pretty much in line, the markets are more or less in line. I guess we'll get more updates from Powell next week in the press conference. But it's not driving market behavior just yet. I think maybe as we get closer into 2026, that could shift a little bit. But given the alignment here and the views and kind of what the expectations are, I think for now, markets are focusing more near term on what Powell and the current committee is going to be doing.
Anders Persson of Nuveen and Tannuzzo of Columbia Threadneedle. We thank you both for your time. Happy Friday to you. Of course, a very volatile one in the market. I hope you are navigating it. Now, up next, we're going to have the auction block. Whirlpool makes its junk bond debut and helps to keep sales in that group red hot. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where we're going to highlight the big debt sales of the week. Can't start anywhere else but the Treasury market. We're going to focus on the long and the short end of the curve, the U.S. paying the most to sell 8-week bills in more than 6 months, the latest sign of growing concerns around the debt ceiling. But on the positive side, the highly anticipated 30-year sale saw stronger than expected demand. And over in U.S. high grade, weekly volume coming in below dealer expectations, but issuers were able to show some pricing power, with Bloomberg strategists reporting an average book to cover of 4.8 times covered. Lloyd's, M&T Bank, and Analog Devices were among the biggest sales. And in high yield, about $16 billion in deals so far in June. Whirlpool added to that number by pricing $1.2 billion of high yield notes in its first bond sale since being downgraded to junk. Now, when it comes to credit, Matt Miskin from Manulife John Hancock Investments is focused on quality.
We're in higher quality parts of the bond market. Quality, again, in bonds is on sale on a relative basis because high yield spreads have tightened up again. And so when we look cross asset, we actually do see the longer end of the curve isn't the worst decision. We're more in the intermediate. And again, being patient, getting paid income, and watching a lot of these narratives play out in the narrative merry-go-round of global markets.
Joining us now, Maureen O'Connor, Wells Fargo Global Head of High Grade Debt Syndicate, and Zachary Griffiths, Creditsights Head of U.S. Investment Grade and Macro Strategy. Risk is a relative word, isn't it? Maureen, when you think about investor demand for corporate debt right now, how willing are they to take on credit risk?
Well, I mean, I think, just the collapse in credit spreads that we've seen since the wides in early April to now will tell you just how, consistent the demand is for this asset class across a wide variety of different market landscapes. Investment grade tends to be fairly resilient, and the snapback has been pretty swift. It's been led by the more tariff-exposed cyclical names that really took a beating back in April. We're back down to pre-Liberation Day levels. So the market is exceptionally firm from a demand perspective. Demand technicals remain squarely intact. And as you obviously introduced in the opening segment, supply's been pretty manageable this week as well. So our near-term view is that spreads are pretty well supported in a fairly narrow range, at least for the next month or so. And obviously there's some unknowns as we get into the back half of the year.
We'll talk about those unknowns, but Zach, are people pricing in risk at this point? You see that snapback that Maureen was talking about, and it makes you wonder whether there's something investors are ignoring.
That's how we feel, Sonali. It seems like we're optimistic in terms of market pricing in that we aren't facing the worst of the tariffs, or at least the worst announced levels. But the economic reality is worse going forward when thinking about tariffs now at around 15% in the U.S. effectively on the globe versus 2% in 2024. That either means higher consumer prices or margin compression, and we don't really think the market is priced for either. So when we think about how much spreads have snapped back, it surprises us and feels a little divorced from the economic reality we're facing going forward. So I agree with Maureen that we're probably in a fairly tight range for now. It seems like technicals are clearly in the driver's seat, but we're a little more worried about fundamentals as we move into the second half of the year.
Investors in the United States this morning had to throw out a playbook, given the geopolitical tensions we're seeing simmering in the Middle East. Maureen, how do geopolitics play a role in risk appetite?
Well, I'd start by saying I don't love to be cavalier about geopolitical risks because it only takes one meaningful escalation to really change the market narrative pretty quickly. But as far as investment grade is concerned, our market does tend to be a little bit better insulated than other asset classes when it comes to geopolitical. So today you're seeing a little bit of modest spread curve widening, but it's been balanced by the fact that we've actually seen a pop in Treasury yields, and that's kind of supported spreads here, at least near term. Ultimately, our market's going to be much more tethered to economic data, monetary and fiscal policy, and of course, trade policy being kind of the number one question mark for the second half. So from our perspective, our market will likely take this in stride and will decouple a little bit from the price action that you're seeing in the equity markets, pending any further escalation from here.
Zach, how do geopolitics play a role here? And are there certain sectors that are perhaps more exposed than others, particularly given the surge in oil prices we've seen on the heels of that Israel attack on Iran?
Yeah, there are a lot of counterfactors to consider. And when we think about higher oil prices, I think that's been one of the big bright spots in terms of inflation is gasoline prices have been coming down. So thinking about consumer discretionary and the ability for the consumer to continue spending if we're facing really elevated or moving higher oil prices going forward, that's something to consider. But in terms of geopolitical risk being priced in, it feels like it hasn't been a big driver. It feels like every month we have a new geopolitical headline, and yet spreads have tightened in a ton. So I think there is definitely a sector-specific angle to it. But for right now, the market as a whole seems to be ignoring concerns from the geopolitical side and is more focused on this optimism, at least coming off the worst of tariff volatility from a couple months ago. So we've been a bit surprised in terms of how resilient the market has been in the face of such elevated geopolitical risk.
Maureen, what is the biggest question you're getting from investors right now, given kind of the maelstrom of risks out there?
I think everybody always asks when we get to really lofty valuation levels like we're at right now, what is it that's going to actually turn the tide? And from our perspective, it's going to be a meaningful turn in the hard data. And we do see risk to that in the back half of the year. Obviously the continued uncertainty around trade policy, this is going to be a drag on growth. It's going to be a drag on the consumer. And we're ultimately going to see wider spreads in the back half of the year. Where we're going to see the most exposure, it's the triple B names, it's the more cyclical names, it's the more tariff exposed names. So the question then becomes, how do you position your portfolio against a backdrop like that? It's up in quality, so decompression across the rating spectrum, much like we saw back in April. And it's up in liquidity as well. It's favoring the larger, more liquid debt stacks versus the more one-off names. So from our perspective, there definitely is a risk to wider spreads. We actually just put out a revised forecast for spreads to be about 25 basis points wider at the index level by year end.
Fascinating. To that end, Zach, one question I've had on my mind this whole show is, why are investors accepting spreads that are still so tight? Are they risking here waiting for a better entry point? And should they be paying more attention to valuation?
We think they should, Sonali, and we agree that spreads should widen through year end. One of the things that we've been considering in looking at how tight spreads are to treasuries are the idea that treasuries have cheapened versus swaps. And if you look at corporates on an asset swap spread basis, over time, they're a little bit less rich. And so we are incorporating that into our consideration as you see a cheapening of treasuries, more concern about what's going on with the budget deficit here in the US and the ultimate path for that. Maybe we should be considering corporates against other benchmarks in terms of the balance of risks. So overall, we do think spreads in general are a little bit too tight when we look at the economic fundamentals going forward and the pressure that we see. We are starting from a solid starting point in terms of corporate balance sheets, so we're not looking for a huge move wider, but we don't think you're really getting paid for the risk in the system right now.
We got to leave it there. That is Maureen O'Connor of Wells Fargo and Zachary Griffiths of Creditsights. Wild thought to price corporate debt against something that is not the Treasury market. We will dig into that more in future shows. But some breaking news here that we want to bring you to. Reuters reporting that President Trump says U.S. officials still plan to meet with Iranian officials for talks this Sunday. Now, Trump reportedly saying this in a phone interview, according to Reuters. Those talks are set to take place in Oman and were scheduled before Israel began the strikes on the Iranian military. We will bring you more as we get it. Want to remind you also that President Trump earlier urged Iran to accept a nuclear deal. We will bring you the updates as we know them. This is Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up Monday, the G7 summit is underway in Alberta, Canada. And Tuesday, U.S. retail sales data. Wednesday, the Fed rate decision and remarks from Fed Chair Powell. Thursday, another rate decision, this time from the Bank of England. U.S. markets are closed for the Juneteenth holiday on Thursday. And Friday, U.K. retail sales earnings, CarMax and Kroger earnings as well. And for my final thought, be sure to find on Tuesday the debut of Bloomberg Original's brand new show, Bullish, hosted by me, where we talk to finance titans, rising stars, and you're going to have a few things about the bond market as well. The show premieres Tuesday, and from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.